Well, the big question for Fed officials at their meeting 3 weeks ago was how much higher interest rates are affecting the economy. Although monetary policy is restrictive, the minutes say, many participants commented on their uncertainty about the degree of restrictiveness. High rates, they felt, might be having smaller effects than in the past. The neutral rate, or R*, might be higher than previously thought, or potential growth might be slower than they had estimated. For now, the decision was to maintain the current policy path for longer should inflation not resume falling. But various participants mentioned a willingness to tighten policy further should risks to inflation materialize. They noted disappointed readings on inflation over the first quarter and indicators pointing to strong economic momentum. There was also concern about risks to financial stability in a higher inflation environment, including unrealized losses on assets, high commercial real estate exposure, significant reliance by some banks on uninsured deposits, and cyber threats. Several participants commented on the rapid growth of private credit markets, warning they should be monitored because some risks from those markets may not yet be apparent. The overall economic assessment, though, pretty much as you've heard from Fed speakers over the past 3 weeks, they expected inflation to continue falling towards their 2% target, but were disappointed by the apparent stall in the first quarter. That reduced their level of confidence in what was happening. A bit of a list of what they're looking for going forward is in the minutes. Lower readings on rent growth for new leases, a decline in wage growth in non-housing services, and perhaps higher productivity. There was general agreement that higher rates of immigration were keeping labor markets relatively tight. Nothing basically that we've heard since then changes the outlook, and nothing in these minutes really disabuses the higher for longer narrative, guys.